$5.3 trillion. That's Nvidia's current market cap. For reference, that's larger than the entire GDP of Japan. It's larger than every publicly traded company in the United Kingdom, combined. It's more than the total value of gold held by every central bank on Earth. And it belongs to a company that, 15 years ago, was mostly known for making graphics cards so teenagers could play Call of Duty without their games looking like a potato. Now, I want to be clear about something before we go any further. This is not a video telling you Nvidia is a bad company. It isn't. Nvidia is genuinely one of the most impressive engineering organizations in the history of the semiconductor industry, and anyone who tells you otherwise is probably trying to sell you something with worse fundamentals. But here's the thing. Great company and great stock price are two completely different conversations. And right now, the stock price is telling a story that I think deserves a lot more scrutiny than it's getting. So today, we're going to look at what's actually happening underneath the surface of the most hyped stock on Earth. And some of what I'm about to show you, I promise, you have not heard before. Let's start with the number everyone keeps using to justify the valuation. Revenue. Nvidia's data center revenue hit $39 billion in a single quarter, up 56% year over year. Those are genuinely staggering numbers, and the bulls will point to them every single time someone raises a concern, like a kid holding up a report card to change the subject. And they're not wrong to point to them. The revenue is real. The growth is real. But here's the part that doesn't make the headlines. 61% of that revenue comes from just 4 customers. Not 40 customers, not 100, 4. And Nvidia doesn't even tell you who they are. They show up in the SEC filings as customer A at 22%, customer B at 15%, customer C at 13%, and customer D at 11%. Mystery guess, running up a $35 billion tab. The most logical guesses are Microsoft, Amazon, Google, and Meta, which brings us to the part that should make you deeply uncomfortable. Those 4 companies aren't just Nvidia's biggest customers. They're also Nvidia's most motivated competitors. Every single one of them is actively spending billions of dollars building custom AI chips specifically to replace what they're currently buying from Nvidia. Amazon has Trainium, Google has TPS, Microsoft is co-developing chips with OpenAI, Meta is doing the same. The very people writing Nvidia's largest checks are simultaneously funding the escape hatch. In other words, Nvidia's entire business model right now depends on 4 companies that are openly, publicly, and aggressively trying to need them less. That's not a customer base. That's a countdown. And here's the mechanism underneath it. When a company gets as dominant as Nvidia, its biggest customers don't just accept the dependency. They budget against it. They call it diversification of supply chain. What it actually is a slow-motion replacement project funded by the profits they're generating while they're still dependent. The 4 largest cloud companies are projected to spend a combined $700 billion on capital expenditures in 2026. Most of that is AI infrastructure. And a meaningful portion of it is going directly into the effort to never need Nvidia this badly again. It's a feedback loop that's beautiful right up until it isn't. Now, if you're starting to feel a slight sense of déjà vu, you're not alone. Because we have seen this movie before. Not the dot-com bubble, not 2008. I'm talking about a specific episode most people have completely forgotten. In the early 1970s, there was a group of stocks called the Nifty 50. These were the blue-chip giants of their era: Coca-Cola, McDonald's, Xerox, Polaroid. Institutional investors called them one-decision stocks, meaning you only had to make one decision when it came to these companies: buy. The idea of ever selling was considered crazy. These were untouchable, category-defining businesses that would grow forever. And because of that belief, investors priced them accordingly. Polaroid traded at 90 times earnings, McDonald's at 86 times earnings. The average across the whole group was 42 times earnings in an era when the rest of the market sat at a modest 15. And then gravity showed up. By 1974, Coca-Cola was down over 60%, McDonald's down more than 70%. Polaroid, the most beloved of all, collapsed over 90%. Not because those companies stopped being good businesses, but because the price paid for them had completely decoupled from any reasonable expectation of future returns. The valuation had become the risk. The certainty was the trap. So, where does Nvidia sit today? Well, Nvidia currently trades at around 32 to 35 times forward earnings, which on its face sounds almost reasonable until you zoom out. Because that's the multiple on expected earnings in a world where 95% of companies have reported zero return on their generative AI investments so far. In a world where the entire bull case depends on a wave of corporate AI spending that has not yet translated into corporate AI profits. Meaning Nvidia is priced for a future that has not arrived, built on customers who are trying to replace it, in a market that is priced in perfection with zero margin for error. And then there's the insider selling. Jensen Huang, Nvidia's CEO and founder, has sold more than $2.9 billion of his own stock through pre-arranged trading plans since mid-2024. Just let that number sit for a second. $2.9 billion. And here's the kicker. After selling nearly $3 billion of his own company shares, he still owns enough stock that the sales barely register as a rounding error in his total position. So is that bullish because he clearly isn't panicking? Or is it the most expensive slow exit in stock market history? The answer depends entirely on what you think happens next. What I can tell you is that the pace of selling accelerated. It went from $462 million in 2023 to over $2 billion in 2024. That is not a coincidence of timing. That is a plan. Which brings us to the part of this story that I genuinely think nobody is pricing in. Nvidia lost $589 billion in market cap in a single day. January 27, 2025. The largest single-day market cap destruction in the history of the American stock market. And the reason was a Chinese AI startup called DeepSeek, which released a model that appeared to match the performance of the best American AI systems at roughly 1/11 of the compute cost. The market panicked because if that's true, the entire premise of the GPU supercycle falls apart. If you can get the same AI output with fewer chips, you need fewer chips. And if you need fewer chips, the company selling chips at a $5 trillion valuation starts to look like a problem. And here's what happened next. The stock recovered, almost entirely, within weeks, which either means the market correctly identified that DeepSeek's claims were exaggerated, or it means the market is so addicted to the Nvidia story that a $500 billion warning sign got bought as a dip. I genuinely don't know which one, but I do know that 8 of the 10 largest single-day market cap collapses in US stock market history have happened to the same stock. At some point, that's not volatility. That's a pattern. Now let me tell you about something that has received almost no coverage in mainstream financial media, and that is the regulatory risk sitting directly above Nvidia's head. France raided Nvidia's offices, not metaphorically, physically. In September 2023, French antitrust enforcers walked into Nvidia's Paris offices and gathered evidence on suspected anti-competitive practices. By June 2024, France's competition authority released its findings and concluded that Nvidia is likely abusing its dominance through price fixing, unfair contractual conditions, and discriminatory behavior toward competitors. The European Commission is separately conducting its own review. The United States, the United Kingdom, South Korea, and the EU are all running simultaneous investigations into the same company. Under EU rules, a violation in this category can result in a fine of up to 10% of annual global revenue. At Nvidia's current revenue run rate, that is over $16 billion in a single fine. And right now, the stock price acts as though none of this exists. Here's the uncomfortable truth about Nvidia, and I want to be precise about this. The bull case is not delusional. The AI build-out is real. The CUDA software ecosystem is genuinely one of the most powerful competitive moats in the history of the technology industry. 19 years of developer lock-in, optimized libraries, and institutional inertia are not dismantled overnight. And the 4 biggest cloud companies are still, right now, spending hundreds of billions of dollars on Nvidia hardware because despite everything, it's still the best option available. The bull case has real arguments. But here's what the bull case requires you to believe simultaneously. It requires you to believe that the 4 companies trying to replace Nvidia will fail, or at least fail slowly enough. It requires you to believe that the regulatory investigations across 5 jurisdictions will produce no meaningful consequences. It requires you to believe that the $17 billion in annual China revenue that Nvidia just stopped forecasting is somehow not a real problem. It requires you to believe that the historical pattern of every major technology bubble resolving with a valuation reset does not apply here, because this time, the company is real enough and the AI opportunity is large enough that the normal rules of gravity don't apply. And maybe they don't. Maybe Nvidia is the exception. Maybe this is the one company in history that warrants a $5.3 trillion price tag and keeps earning it. It's possible. But here's the thing about markets. They don't reward you for being right about the company. They reward you for being right about the price. And right now, being right about Nvidia, the company, and being right about Nvidia, the stock, are 2 completely different bets. The company could do everything right, grow earnings at 30% a year for the next 5 years, and still leave investors underwater if the market simply decides that 35 times earnings is too much to pay for even the best chip company on earth. That's not bearish. That's just math. So I want to hear where you land on this because this one is genuinely split down the middle. Do you think, A, the valuation is justified, and Nvidia is the one company that earns a $5 trillion market cap? The moat is real, and anyone calling it a bubble is going to look stupid in 3 years. Or do you think, B. The structural risks are being completely ignored. The customer concentration story is the ticking clock that nobody wants to talk about, and this ends the same way every other one-decision stock story has ended. Or C. The most interesting option, you think Nvidia keeps going up in the short term because the narrative is too powerful to fight, but the long-term math doesn't work, and the question is just whether you can time the exit before everyone else does. Drop your take in the comments because I genuinely want to know how split the room is. And if there's a scenario I'm missing, tell me that too.